I think the market is getting the sense of this, and certainly for private investors who feel that they might have missed the gold boat, having maybe taken profits at $2,000 or $2,070 when you remember that was the top of the trading range for some time, regretting it and thinking we're going to get back in. But how do you buy gold at $4,130 when you've sold it $100 or $1,000 or $2,000 below the current level? This is a psychological nightmare for investors. So what do? Buy silver. It's far cheaper. That way you get it back in the ride, with a little bit of self-respect. So.
Financial analyst Alasdair Macleod notes that the gold and silver markets have entered a critical turning point, with mounting signs that the paper-based trading system supporting them is starting to fracture. He points to rising backwardations and unusual patterns, like higher prices alongside flat or falling open interest, as evidence that short positions are being forced to cover, a sign of market stress rather than new speculative buying. Both COMEX and London's forward markets now show a growing disconnect between physical metals and their paper counterparts. According to Macleod, this shift represents far more than a market correction. It signals the early stages of the fiat currency system's unraveling. He explains that silver's powerful rally stems from years of deep supply deficits, where industrial and investment demand have outpaced mine output, forcing the market to draw down from shrinking stockpiles. Currently, LBMA vault liquidity is tight, with most silver already locked into major ETFs like SLV. To keep deliveries flowing, large financial institutions are borrowing silver shares from pension and insurance funds at record premiums, a short-term fix that only worsens the structural imbalance. Macleod compares this to a payday loan cycle, a temporary solution that delays rather than prevents a larger crisis. With more investors demanding physical silver and ETFs struggling to source new supply, he believes the silver squeeze is still in its early phase, not nearing an end. Looking forward, Macleod stresses that the current gold-to-silver ratio of around 80-1 is unsustainable as trust in fiat currencies erodes. As the monetary system loses credibility, gold will reclaim its role as the ultimate settlement asset, while silver could see an even sharper revaluation because of its dual monetary and industrial demand. He suggests silver could surpass $100 per ounce, while gold moves substantially higher as capital flees paper assets. With many investors having missed gold's initial breakout, silver is now becoming the more affordable gateway into hard, tangible wealth. Now, we bring you the clips from Alasdair's interview.
Well, I think what you've got to look at is the relationship between speculation and changes in the price. I mean, COMEX is an openly visible market on this one. When you see the price rising and open interest either not following or even contracting, that is a clear sign that the bears are being badly squeezed. And if you look at the level of open interest in gold, it's around about 480,000 contracts, something like that. That's not overbought at all. Yet we've been, as you said earlier, we've been hitting new highs day after day after day. So where's the overbought? It's not overbought. Okay, you look at the RSI indicator. Chartists will say, "Oh, that's overbought," and all the rest of it. But they're looking at the wrong thing. Man does not survive by charting alone. You've actually got to look at the market. So this is a very, very difficult situation for market makers in particular, in futures markets and also in the forward markets in London. I mean, I think in the broader context, what we are seeing is, if you like, the relationship between paper and physical becoming very, very strained. And I think it's a symptom of the end of the fiat currency system. We are beginning to see that the fiat currency system is in huge, great difficulties. Of that, there is no doubt. And fiat currencies don't last forever. They've always got a limited span, and they always collapse, and they always collapse in the same way. They collapse basically because there's just too much debt. The debt just mounts up and mounts up. I mean, the whole point of a fiat currency is you can issue the thing, without constraint. So obviously it gets issued without constraint. So that means there does come a point where the fiat currency can be no more. We've seen, I mean, every collapse of a fiat currency is really from that sort of, from the overloaded debt, the accumulation of debt, and if you like, the dependence of governments on issuing yet more and more currency. Basically, the shortage of silver has built up over a long period of time. I mean, if you look at the Silver Institute's estimates of supply and demand, you can see that it's been supply deficit for the last 5 or 6 years, and it's in supply deficit this year. And the difference is always made up on the Silver Institute's calculations by drawing down on investment stocks, what they call investment stocks. We've come to an end of that. And, the thing that makes it so difficult, I think, is you've got this very limited liquidity. The vast majority of silver in the LBMA vaults is actually for silver ETFs. You look at the big silver ETFs. I mean, basically that accounts for most of it. So the liquidity is actually very, very low, what's actually available. So what we see is authorized participants, as they're known as, the big banks, if you like, who will be listed on SLVs, for example, prospectus. What they can do is they can sell SLV stock for physical. So what they're doing is they're going out and they're borrowing silver, SLV stock, from pension funds, insurance companies, wherever they can get hold of it, and paying a huge, great premium to do it. And actually, it's that there isn't any supply of SLV stock anymore, but they then sell it into the market for bullion and then deliver it, and they're left with a short position. They've got to cover that at some stage in the future. So, this doesn't actually resolve the problem. It just deals with one bank's particular position, short term. It's rather like, payday loans. You run out of money and you've got the bills to pay, and you're not going to get paid until next Thursday or whatever. So what do? You go out to payday lender and you pay 120% or whatever the figure is to, finance your position for 3 days. That's all they're doing. This is just, storing up continual trouble in the market. I just don't see how this one can really be resolved, because the problem is that all this is going into secure hands. I mean, people are hoarding the stuff effectively. And now, because this is so public, people are subscribing for, guess what? ETFs, silver ETFs, which is reducing. I mean, the silver, the managers of silver ETFs they've got a problem, because they've got to now try and find some silver. There's very little available in the market.
Please subscribe to our channel and hit the bell icon to stay updated on the latest developments.